Morning, everybody. Thank you very much for joining us this morning to discuss AVI Japan Opportunity Trust and to review the recent interim results. Just by way of introduction and background to the team and to the company, just before we get started, we're a predominantly London-based team. It's an expanding team which has grown over the last few years. We have one colleague, Jason Bellamy, who's based in Tokyo full-time, but the rest of us are based here. And as Helen said, I'm joined here today by Kaz, head of Japan Research. For those less familiar, and as a refresh for those who have met us, just to set the scene for what AJOT is and how it differs from other investment trusts focused on Japan. We're not a broad-based general Japan fund. We're focused on a specific opportunity set within the Japanese stock market. And that is primarily, and we'll expand on this as we go through, but it's primarily on small cap companies that are under-researched by the other investors and by the sell side. So very inefficiently priced, we would argue. Companies that have got large amounts of cash and other assets sitting idly on their balance sheets. And the reason that is interesting is because historically those have not been valued efficiently by the market. And what's driving all this this interest in this part of the market is the regulatory tailwinds and the corporate reform that we've seen introduced into Japan over the last few years, with the introduction of the Corporate Governance Code and the Stewardship Code, that have tasked companies with doing more for shareholders and tasked shareholders with being more proactive in their engagement with Japanese companies. And all of that has led to a shift in corporate behavior, a shift in shareholder behavior, all of which has driven, and we argue continues to drive, shareholder returns in Japan. In particular, like in any other market, you can always find companies that are cheap, that you can argue are inefficiently priced or mispriced. But very often, there is a reason for those mispricings or those inefficiencies. At AVI, we focus on certain types of companies, and this is true globally and it's true in Japan. We want to invest in good companies that are growing in value. It's no point buying a pound of value today that's trading cheaply, but where that pound is declining in value year in, year out. So we want to be buying durable businesses that are generating free cash flow, that are growing in value, and that we can be patient whilst things happen in our favor. We need them to be trading at a discount because what we want to be doing is exploiting inefficiencies, but we have to be sure that they're genuine inefficiencies. And as part of our modus operandi, very much a proactive approach to investing. We're not waiting necessarily for good things to happen. We're trying to drive that process through. And in the Japanese context, we've become well known as one of the more proactive but constructive shareholders in Japan, and have developed a positive reputation, I would say, within the market. So over the last half year, our performance within AJOT was a 7.7% gain, comparing to the broader Japanese small cap index, the benchmark index, which was just slightly negative. And that extends a period of outperformance over the periods that you see here, 1 year, 3 year, 5 year, and since inception, that has led to quite substantial outperformance over the life of the fund. It's approaching its 6th year anniversary. And that's annualized outperformance of 7.6%, which has led to quite a marked beat of the broader market. And we would argue, and I hope that you'll agree with me by the end of this webinar, that the opportunity set with Japan is no less diminished despite that performance, and the prospects of continued outperformance and exploiting the inefficiencies that continue to exist in Japan ought to continue to deliver attractive outperformance from the market from the opportunity set as we go forward. We'll talk about some of these companies later and some of the characteristics of the portfolio, but just to highlight at this stage that over the last 6 months, we continue to find a lot of interesting new opportunities. It's not a stale portfolio. It's not a passive approach. It's very proactive. We're engaging intensely with all these companies. And despite the relatively strong performance that we've seen in Japan over the last 12 or 18 months, apart from the week in July, end of July and beginning of August, there continues to be an abundance of very attractive opportunities. And when we look a little bit more closely at some of those new names, the interesting feature currently of the opportunity set that has come into the portfolio over the last 6 to 9 months is that they're very much at the small cap end of the spectrum. You see the market caps here. The net financial value, NFV, net financial value, that's cash and other assets as a proportion of the market cap, is in some cases really, really high. In other cases, a little bit more modest. But the valuations of those companies is mid-single digits on average. In some cases, a little bit lower, some cases a bit higher, but very attractive opportunity set relative to the rest of the market. And also stacks up very attractively compared to the opportunity set that we've seen over the life of the fund. So although in yen terms, the fund will have doubled in value or more than doubled in value, there is still no decline or in size of the universe, the size of the opportunity set. And encouragingly, some of those new names feature pretty heavily in the list of contributors towards the top of the page rather than towards the bottom. So that's also encouraging. I'll say a quick word on what we experienced at the end of July and the beginning of August. This is very much a fundamental bottom-up fund, bottom-up stock picking fund, but clearly the macro and the moves in the yen that we saw have been at the forefront of investors' minds over the last month or so. What we saw at the beginning of August was panic, machines, algorithmic trading conspiring really in a relatively illiquid market to drive almost unprecedented returns or declines in the yen, fueled to an extent also by an unwinding of the carry trade and increases in the value of the yen. We've long argued that the yen is fundamentally cheap and ought to appreciate. It's been a massive headwind over the last few years to AJOT's returns, but it ought to be a tailwind going forward. And that is predicated on the economic fundamentals that we've seen in Japan and continue to see, in the sense that inflation is coming back and they seem to have killed off deflation, and moves by the Bank of Japan intending to bring to an end the ultra-low negative monetary policies interest rates that we've seen in Japan over the last couple of decades ought to lead to some normalization. And alongside that, easing from the Fed, leading to a more supportive environment for the yen. What we saw at the beginning of August, though, was carnage, in one word, and that has spooked a number of investors. But encouragingly, two things I would highlight out of that. First of all, we started to see very soon after the 5th of August, we started to see long-term fundamental investors pick up bargains, as we did, really reflecting the fact that the moves were extreme and unjustified, and it was really a buyer's opportunity there. And the other thing that we would highlight is that from our perspective, in our discussions with companies, nothing has changed. So the business environment continues to be robust within our portfolio companies, and the commitment that we are seeing from companies to improve shareholder returns, to improve corporate governance, and to do things to get the share price up, and to be interested in dialogue with us to understand what they can do, continues unabated, really. So we would argue that what we saw is a bit of noise, it's a bit of distraction, and fundamentally, we are as confident as we have ever been in the opportunity set. Just to expand a little bit upon what I said earlier on about the opportunity set being as great as it has been over the life of the fund, what you see at the bottom left-hand corner is the number of universe companies. So these are the companies that meet our criteria in terms of profitability, valuation, proportion of cash and other assets on their balance sheets. So really, over the life of the fund, despite the fact that a lot of companies have appreciated, despite the fact that there's been quite a lot of takeover activity, there are still a large number of companies that meet our criteria. Valuations in Japan remain below those of other markets, and interestingly, AJOT remains well below what we see across the Japanese market. So again, everything is really still to go for. And just as a reminder of how we're looking for opportunities as part of our universe and research process. Next slide, thank you. So our starting point is, as I said, that we're focusing on primarily small cap companies, some mid cap companies. So our range really happens to be between 50 million and 4 billion pounds. We're looking for companies that have got more than 30% cash to market cap, and we're looking for companies that are trading, generally speaking, in single-digit earnings multiples, and that don't have a shareholder register that's dominated by cross shareholders, by allegiance shareholders that are likely to be an impediment to anything that we suggest. We spend a lot of time researching these companies, not only meeting the companies, but meeting companies in the peer companies in the industries, meeting expert networks, employees, ex-employees, conducting or arranging to be conducted third-party appraisals of any other assets, particularly real estate. And then it's about developing an engagement plan with that company, identifying why it's cheap and what ought to happen in order to correct that undervaluation, and asking ourselves whether we think the company will actually play ball with us, or will they try and resist our efforts to engage. From a diversification perspective, there is no particular top-down sector approach. We want to end up with a portfolio that's broadly diversified, but we don't need to have representation in every industry, and certainly our allocation doesn't need to look and won't look like any benchmark. It's much more bottom up, but clearly we want to avoid having too much concentration in one particular sector, and we want to have broad Japanese exposure. I'd also say that when you look at the portfolio today, and in the context of discussions on what's going on in the yen, our portfolio is very largely domestically focused. Roughly 80% of the revenues of our companies come from the Japanese domestic market. So to the extent that the large cap performance that we've seen over the last couple of years in Japan has been driven by the exporters, and the sense that a weak yen has been beneficial to them, our portfolio, along with a lot of the small cap companies, are much more domestically focused and much more of a pure play on the Japanese economy. The other feature that's worth noting about our portfolio is the concentration. The process of engagement, which I'll elaborate on in a minute, is very intense, and I would argue there's no point having 50 companies. You can't engage that intensely with 50 companies, and also when you get a result, you want the result to move the needle and to be felt in the performance. So our portfolio is concentrated. The top 10 amount to around 66% currently. It's been as high as around 70%. And we reckon we have in the portfolio at any one time approximately 15 core names. There may be a few more names at any given time, as some are coming in and some are going out, but there are roughly 15 core names within the portfolio. And the portfolio companies, when you look at their some of their characteristics, I've spoken about buying good quality companies that are growing in value. That's very much the case when you look at the earnings, revenues, and profits of these companies. They've compounded at relatively attractive rates compared to the broader market. So our approach to engagement is different to others. It's predicated on the idea that we want to be constructive. We want companies to view us as supportive shareholders, almost as partners. In Japan, there is some distrust to foreign investors, and that's built around the idea that foreign investors want to make a quick buck and they don't care that much about the Japanese economy. We position ourselves differently. We position ourselves as long-term investors that want to achieve what's best, not only for ourselves, but also for the company and all its other shareholders. And to that end, we want to work hand in hand with management, not against them. So typically, we want to be an important shareholder. And in most cases, to be an important shareholder in Japan, you need to own a high single-digit percentage stake. And often, not always, but often, that will get you a top 3 position in shareholder rankings, and management will then take you quite seriously. Occasionally, we'll be substantially larger than that, and we'll have a plan, a more proactive, explicit plan to unlock value. And in some cases, we'll be smaller and try and use our influence there as well. Particularly in larger companies, it's obviously harder to achieve. But the idea really is to, if you move on one slide, is to take a stake, present companies with a very detailed presentation, highlighting how we understand their business, where we see the opportunities and where we see the challenges, and what we think they ought to do about it. And oftentimes, we're not coming in like some investors and saying, you've got too much cash, you've got to give it back to shareholders. Companies in Japan recognize now that they can't allow the cash on the balance sheet to build up blindly, but they're still very resistant to the idea of giving it all back to you at once. And if that's all you've got in your pocket when you come to argue with companies, you've got too much cash on the balance sheet, and that's why you trade cheaply, you're already starting on your back foot, because that's boring to companies. You're just another boring foreigner who wants to make a quick buck. But if you come, as we do, with detailed presentations focused on the operations, on the strategy, focused on suggesting some opportunities that they could exploit, some positive uses of their cash rather than simply giving it back to shareholders. And along with that, we suggest some more efficient capital allocation measures such as share buybacks or higher payout ratios, then you're taken a lot more seriously. And particularly when we try and keep things as we do in the private domain, companies feel comfortable with us in the knowledge that we're not going to embarrass them publicly, and we're not going to bully them publicly unless we kind of have to. And that's reflected in some of our recent engagements. 2 examples here: Aichi, attractive operating business that's controlled by Toyota Industries, and then a less successful investment up until recently, which SK Kaken, been in the portfolio since the start of the fund, but we've been putting increasing amounts of pressure, and that's yet to yield demonstrable results. But there has been a turning point in the relationship between us and the company, and so we watch this with interest. And just finally, in terms of the backdrop, we've used this slide since the launch of the trust 6 years ago, and it's continued in all respects in the right direction. So there are many more shareholder proposals being submitted each year to companies in Japan. Share buybacks continue to increase quite a hefty rate, and the number of companies in Japan that are now doing share buybacks has more than doubled over the last 10 years. Cross-shareholdings continue to decline, and general corporate governance, as reflected by the number of independent directors, continues to improve. And all of this really supports the idea that Japan today is a very different market from where it was 5 years ago, 10 years ago, 20 years ago. The commitment by companies today to shareholder returns is a completely different sphere to where it was back then. Companies don't hide away from shareholders. They engage with shareholders, and they want to get the share price up. almost as much as we do. So a very good environment. And let's just end off briefly with a description of some of the new names that have come into the portfolio. I'll hand over to Kaz for this.
So as Joe shared earlier, so we see more and more interesting opportunities in Japan, and I like to give some highlights of those new ideas. So we see the current market environment very positively, with more companies are aware of the issues of the capital structure under the Tokyo Stock Exchange, putting a lot of pressure to be more cautious and aware of the cost of capital and the valuation, as well as more activist investors are entering into the market. So the typical example is BNOS. So currently, if we combine not only the cash, but also the securities that the company has, it is more than its market cap. So meaning that the enterprise value is currently even negative. So after our declaration of ownership, currently 4 other activists declared ownership in this company, totaling 40% of the ownership of this company. So we have been engaging with the CEO and other management very frequently. So we see a sizable upside in this company. So the next example is Kurabo Industries. So as Joe highlighted, the operational engagement is our core focuses. So we have sent a very detailed, lengthy presentation to the company, highlighting the issues not only about the capital structure, but also Kurabo's conglomerate structure. So the company operates the not only the textile business, but as you see on the lower end corner, they operate like functional resin, other chemical business, electronics. So the conglomerate structure we see as one of the key issues of the company's annual evaluation, not only the capital structure. So we have been engaging with management very intensely. And then the last example is Aoyama Zaisen. So this is the only company in Japan focusing on the wealth management business. So we have been targeting this company partly because of its very high margin on a normalized basis, more than 30% of the EBIT margin, combined with the very strong growth in the business. So we have been speaking with the very senior management layer as well as the external brokers. We have shared a letter to the company. So the company already started discussing internally how they rectify its undervaluation. So we also see Aoyama Zaisen as a very interesting opportunity.
Thanks, Kaz. So with that, I'll conclude and open up to any questions. But in short, in summary, I think we've proven over the last 6 years that there is a very real opportunity to exploit inefficiencies that exist in the Japanese stock market by virtue of cash on the balance sheet and the lack of research, and that the environment is very much changed by virtue of the corporate reform, corporate governance reform, the stewardship code that were introduced almost 10 years ago now in Japan, but have really altered behavior and altered the commitment to shareholder returns. And despite the performance of the market and despite the outperformance over the life of the fund, we continue to see a very fertile and rich opportunity set for us to exploit going forward.